Hello traders, in this lesson we will find out what the hidden divergence is. In the last lesson we talked about regular divergence, so let's go over the important things. What is divergence? It represents a deviation of the indicator. In this case it is RSI indicator in relation to the price movement on the chart. So if, for example, the price shows a higher peak than the previous one, and the indicator shows a lower peak compared to the previous one, we have divergence. In this case, it is a bearish divergence because it is between 7 to 100 range. It is overbought zone and it gives us sell signals. What does divergence indicate? It indicates a reversal of the trend, in this case from rising to falling. We also can see a bullish divergence here. What do we have? The chart shows a lower bottom than the previous one, but the RSI indicator, I hope you see, shows a higher bottom than the previous one. So it is a bearish divergence, and it tells us that there may be a trend reversal, in this case from downtrend to a rising trend. Now, what is the hidden divergence done? Hidden divergence is also a price deviation, but now the situation is reversed. Look at this bottom here. It corresponds to this bottom on the RSI indicator, and this here, bottom on the chart, corresponds to this bottom on the indicator. I will connect these points so you can see it better. When I draw the line, we see that the second bottom is higher than the previous one. When I connect the two bottoms on the indicator, we can clearly see that the second bottom on the indicator is lower than the previous one. So don't be confused by this divergence or regular divergence. Is a situation, in this case this is a bullish divergence, and it indicates a potential trend reversal of the chart. It shows the lower low while the indicator shows the higher low. We see the opposite here. The indicator shows a lower bottom than the previous one. While the price shows a higher bottom than the previous one, the hidden divergence here on the chart is not an indicator of a trend reversal, but the opposite. Hidden divergence is an indicator of a trend continuation. So when this situation comes up on the chart, you can expect a trend continuation. As you can see, both regular and hidden divergences are very similar, but it's very important not to mix them as they give different signals in trading. How will you be sure that it is a hidden divergence? Simple, always pay attention to the second point. If in the oversold zone, the second bottom is lower than the previous one, this is a hidden divergence. If hidden divergence would occur in the overbought zone, then the second peak on the indicator is higher than the previous one. Regular divergence in the overbought zone always has a second peak that is lower than the previous one, while in the oversold zone, the other bottom is always higher than the previous one. See the difference? Just minimize the chart a little. You can see this divergence is a regular, while this one here represents hidden or false divergence. The first one, that is regular divergence, is an indicator of trend reversal, while hidden divergence is an indicator of trend continuation. Well, that would be it. Now, it would be good for you to open your platform, choose the currency pairs that you trade with, turn on the RSI or stochastic indicator, move the chart back a bit, and try to mark some regular and hidden divergences and try to bring a conclusion on the movement that occurred after the divergence on the oscillators. I'll see you